Welcome to the Real Vision Daily Briefing. Today, it's really only about one thing: the 10-year U.S. Treasury bond near 52-week highs. That's about it in terms of the market action. We've got Peter Boockvar, the CIO of Bleakley Advisory Group and the editor of the Boock Report, to break that all down with us. Welcome back to RVDB, Peter.
Thanks, Ed, for having me.
Not very interesting day today in the markets, in the equity sector. I'm just looking at the indices, how they closed. The Dow up barely, NASDAQ down a bit, S&P down. But, the real action was in bonds. And it makes me think about inflation and your calls on inflation. What are you thinking about given the price action that you saw today?
Well, inflation expectations were little changed, but that's after jumping again on Friday, where the 10-year break-even broke out to a fresh 8-year high, and the 5-year break-even is just about the highest since '08. The nominal change in interest rates today has the long end sort of creeping back up to that 175 upper end of what's been this range. I do think we break out of this range, but maybe just not yet as we sort of digest this move. I think the market is sort of sniffing out, of course, this grand reopening that we're going to have, is now we're vaccinating 3 million people a day, and what that means. I actually, on the way to work today, saw a now hiring sign in front of a local restaurant. So I think they're all getting ready for this sort of transition. But at the same time, we've had to deal with this sort of third or fourth wave. I don't even know what number it is in Europe, and worries about these extra variants in Brazil. But I'm of the opinion, as long as we keep vaccinating more people every single day, even though obviously in some parts of the world it's going rather slowly, that we are moving past the worst of this, and that Europe will be the caboose here, of course, but it will eventually get to its destination.
When you talk about Europe, immediately it makes me think about the narrative, especially in bonds. This is how I'm thinking about it. So we had this range. We were actually below on the 10-year U.S. Treasury bond, below 1%. We traded into the range between 1 and 150, broke out to the upside. We were well towards the north end of the range where we are now, again, between 150 and 175. And then suddenly last week, everyone was like, the third wave, bad things. And it seemed like, it took a hit, the whole concept that we were, going to go up in terms of the yields. But now here we are back again at 171. Is it that the markets now they've forgotten about Europe, or what's going on there?
Well, they haven't forgotten, but they know that, again, as slow as the rollout of the vaccine has been, they know that it's happening every day, every week, every month. More and more people are getting vaccinated. So there's that that light that people are pointing to, that it's we're having these setbacks and we're having to deal with it. But just look at Merkel last week, where she announced that she was going to call for a 5-day holiday around Easter, and people revolted, and then she quickly backtracked. And the world wants to open, and yes, the vaccine is going to help that process. But if the German people are any indication, it's going to happen even with a slow rollout. And even the UK, which has done a very good job of rolling out its vaccine, they announced more steps to do that. And so I think people see where we're headed, and even with the bumps along the road. And I think that's why the bond market is adjusting. I mean, the bond market, we talked about this last time with Jim Bianco, is that the bond market is now setting interest rates rather than having the Fed bully the market into where they want interest rates to be.
Right. Underlying all of this really is the concept. It's inflation expectations, and potential inflation coming going forward. The first thing that I'm thinking about is your note about the Dallas Fed and the numbers that came out there. What were you seeing in terms of the data today?
So one of the things, so there are differences of opinions on whether the inflation we're seeing is transitory or not. And some people say, well, a deciding factor of that will be how do labor costs respond to the recovery and the current rise in prices in a variety of different things. And then on the other hand, you can say, well, I don't recall there being a labor cost push in Venezuela to explain the inflation spike there. I don't recall labor cost inflation being a main reason why Zimbabwe had major inflation. So I don't necessarily think you need that. However, in the Dallas Manufacturing Index, which you mentioned, we do have a bunch of different quotes from companies in different industries that are talking about higher labor costs. And they specifically talked about how the recent extension on unemployment benefits and the enhancement of them via the $300 extra that will last through September is resulting in people that are probably sitting on that rather than jumping into the labor force. So while people talk about the 10 million jobs that haven't been recaptured, I do think what we're going to see is a even lower labor force participation rate on this recovery, which means that it will be even more challenging to bring people off the sidelines, and it will take higher labor costs in order to do so. So I mentioned that restaurant on my way to work that I passed that says now hiring. I wonder how much they're going to pay to hire since now they're competing against very generous unemployment benefits, which they didn't have to compete with last year because they were closed and were just maybe doing delivery. Now they want to reopen, and the level of benefits now is highly competitive to lower wage income that these people are going to have to, like, as I said, compete with.
Well, labor costs are one thing, and then also there are the input costs, especially in manufacturing. Where are you on that in terms of input costs rising and whether or not that's transitory or something that could last longer? Because, at the back end of this interview, I'm going to speak to Trevor Hall. He is an expert in the mining stocks, and I think that he's looking at it as a secular trend.
Well, on the commodity side, I do believe that the underinvestment that we've seen for the last many years is now catching up to us. I don't recall in the massive number of SPACs over the past year seeing copper SPACs or nickel SPACs or crude oil, natural gas SPACs. I mean, maybe there was a few that I didn't catch, but that was not really the fancy of investors. I mean, you take oil and gas. CEOs see what's going on around the world. They see every single day there's somebody out there that wants to shift to renewables. So you're not going to get a massive wave of investment in that area of energy and crude and natural gas because they're worried about the secular trends that are running against them, and they'd rather run their businesses for cash. You can't just snap your finger and bring a copper mine on. That takes years. So copper being a very important industrial metal right now in the context of where the world is headed in terms of renewables and so on, it's going to take time to bring these mines on stream. So I do think that has a multi-year tailwind to it. To your other question about supply chains, yeah, I guess at some point, supply chains around the world, which you saw the dress rehearsal back last year when supermarkets had trouble refilling their shelves because you obviously had a large demand spike as people didn't go out to restaurants, they ate at home. And then, of course, you had a lot of trouble on the supply side in being able to produce meats and so on. And then, so that may normalize faster, but I don't necessarily think it's going to happen so quickly because I think supply chains have been disrupted for both cyclical and secular reasons. Secular reasons because companies are diversifying supply chains, some out of China into other places, that it's easier said than done. And then, of course, you have these logistic costs, which have added another layer of inflation because everything that's produced ends up on a ship, a plane, a truck, and a container on the ocean. So that's going to take time. And I've followed, dry bulk shipping for a while, and I follow the container shipping industry for a while. And there's been massive rationalization in the container shipping market. The dry bulk business has been a complete disaster for years. So there's been a dearth. So in response, there's been a dearth of supply of a lot of these dry bulk ships and container ships. You look at the trucking industry, at least in the U.S., 2 years prior to COVID, you've had a slew, actually maybe more than 1 year, a slew of bankruptcies that took a lot of capacity offline. So I think the logistics and transportation costs are going to remain with us longer than we think, while the supply chain, how much that normalizes when people fully go back to work, probably quicker, but it's something that I'm watching. So I'm not confident enough in saying, is it going to go to 2022, 2023? I'm not sure yet, but we are in the heart of these disruptions right now.
So essentially, we have multiple sources of potential inflationary pressure, from labor to supply chains to commodity prices. And these aren't things that are just about a base effect from the shutdown that we had last year. It's something that you're saying is going to last, let's say, 6 months, 12 months, 24 months, long enough that it could have an impact on inflation expectations and also on interest rates. How far do you think interest rates can go in that kind of environment?
Well, before I answer that, I also want to talk about the services side, which is a key part of this aggregate inflation story. And I mentioned transportation costs, obviously, is a service. We've already seen that. The question is to what extent do the other chunkier areas of the service side of the economy, did they start to see higher prices? We're obviously already seeing airline price increases. Hotel companies are having leverage. But the other two are really rents, imputed rents, and healthcare. Healthcare is going to do what it's going to do, regardless of any of this. And that'll probably see continued persistent increases in healthcare. But that really only shows up in CPI. Healthcare and PCE are mostly Medicare and Medicaid reimbursement rates. So those prices will be whatever the government wants them to be. On the rent side, the question is when do the current 10% plus annual increases in home prices start to bleed into the imputed rents that show up in PCE and CPI? And you could chart over the last 20 years that the rise and decline in home prices as where they go leads those imputed rents. So I'm of the belief that that is now going to follow. We saw sharp rental declines in New York, San Francisco, Chicago, Boston, and other big cities as people went to the burbs and the kids moved in with their parents. You can be sure a lot of these kids are going to be, and I call them kids, but call them, in their 20s and early 30s, they're going to be going back to cities, or at least they're going to be moving out of their parents' apartments or houses. So I do think there will be another inflection higher in rents, both for that reason and, as I mentioned, capturing the rise in home prices. That if you get that combined with what we're seeing on the goods side, if that were to continue, then you get both get both goods and services inflation. That gets to your question of where do rates go on the upside in response to that. And I think the 10-year is going north of 2%. Already, I think maybe in the short term, we've probably seen most of the move, 90 basis points to call it 175 on the upside. I think the market's going to want to see how transitory March and April and maybe May are going to be. And then we set ourselves up for the next leg. And after that, when people realize it's not so transitory. So north of 2%, I know that's not necessarily a bold call now with us being at 170, but I was been saying 2% for a while, even when the 10-year was 1.25. Now, past that, it gets really tricky here because I do think you get north of 2 and things start to break in the markets. And that while the markets have tolerated this rise in rates so far outside of adjustments in tech, I'm not so sure how much it will tolerate a higher a 10-year north of 2. And then that gets into the question of, well, how does the Fed respond? How does an over-indebted economy respond to this move higher in rates, the higher cost of capital that companies are going to have to endure? We have to see. If at 2 everything's still fine, then I really believe that the bond market is going to push the limits, is going to push markets to the point where it will negatively respond. There's not going to be a Goldilocks scenario here where we're going to get this recovery, rising rates, everything's going to be fine. I do think we're going to reach that a breaking point of some sort, but just trying to figure out what that is. We saw that in the fourth quarter of 2018 when it was essentially a 2.5% Fed funds rate, and policing was going to keep on going. That broke things. So it was really, we didn't know. Just like tapering QE was, it's going to be like watching paint dry, but eventually you were going to hit a wall at some point, and we saw that wall hit both in the fourth quarter 2018 and also the fourth quarter 2019 when the Fed basically started QE4 because they were worried that maybe we reached too low a point in reserves. So bottom line is the market's going to test the resolves in the markets, and I think it's going to push it to the point where it will spill over, and then we'll see how the Fed responds to that.
I think that makes a lot of sense, what you're saying. The interesting bit about what you're saying when you use the term Goldilocks is it's almost as if, if you can have rates that are low, and that's bad because that shows that the economy is doing poorly. But then you can also have rates that are too high because basically a lot of things break, as you put it. And there's some sort of sweet spot. We don't know how high rates can go before the breakage occurs. And, you're trying to get into that Goldilocks environment, and you're saying that the breakage is going to happen. The markets will push the Fed to actually commit itself one way or the other based upon that breakage.
Right, because I probably said this before in Real Vision, is that we don't have normal economic cycles anymore. We have credit cycles. We have credit cycles that ebb and flow with the price of money. And because we're hugely dependent on credit, both at the government level, the household level, and the business level, and we're also very market dependent with the intertwining of economic activity and the level of the markets, that the direction of interest rates is a huge determinant on where markets should be priced and what the economy is going to do. So it's inevitable that you reach a breaking point, I believe, if the long end rates continue to rise. Of course, the Fed's going to do their best to keep short rates as low as possible for as long as possible, but that's becoming more irrelevant because, like I said, the market is really setting the price of money here on the longer end, and the Fed is becoming less influential here.
The interesting thing, just going back to a much earlier in the conversation about Europe, is the dollar index, and also differentials in terms of what's going on in Europe, what's going on in the United States, and then thinking about emerging markets and the dollar. Because the way I'm thinking about it is the story that you're telling is look, the markets are we're going to open the economy eventually. Okay, there's light at the end of the tunnel. We don't know how long the tunnel is going to be, but we now know because of the vaccine that the tunnel is of a finite length, and we can see the light at the end of the tunnel. But as things start to go up in terms of yields, that seems to be having an impact on the dollar. I'm looking at DXY. It's at almost 93. And then when you think about some of the emerging markets, it's even worse for the emerging markets in terms of the dollar impact. How does that play out in terms of, A, what do you think is going to happen? And B, what does that mean in terms of your asset allocation across different geographies?
Well, I like to break down the dollar amongst different groups of currencies. It's very easy to look at Dixie and say, okay, the dollar's doing this, it's doing that. But half the dollar index is the euro. So you get the euro right, you'll get the dollar index right. So the euro has weakened here a little bit, but 118 hasn't really weakened that much. But it is weakening because, as we talked about, Europe is obviously very slow with this vaccine rollout. I do think in the months ahead, when they catch up, the euro will have its bid again. I mean, the problem with the dollar, big picture, 30,000 feet, is the twin deficits, the fiscal deficit and the trade deficit. Those are two inherent structural headwinds for the dollar. And that's why the dollar will continue on a secular basis trend lower. In the short term, it's going to have its bounce against the euro because of what's going on in Europe. But, the pound at 137, 138 hangs in pretty well because they're rolling out the vaccine pretty nicely. Canada's not doing a good job, but you know what? The Canadian dollar, 125, 126, that's at a good level against the U.S. dollar. Dollar's not strong against the Canadian dollar. Dollar's not strong against the Mexican peso. The dollar's not really that strong against most of the Asian currencies. Yes, it's strong against the Turkish lira because of what we saw a couple of weeks ago with what Erdogan did in firing the head of the central bank. Yeah, it's traded well against the Brazilian real, but they can't get control of their virus, and now they're dealing with another variant, and all the political issues, Bolsonaro, and so on. So to me, the dollar's not necessarily really strong. It's just really responding to weakness in some of these countries that's affecting it. It's trading okay against the yen here, but the yen goes back and forth between being a safe haven currency, responding to this review by the Bank of Japan, and how they're going to sort of recalibrate their policy. So the yen is I'm not sure what the yen is anymore. I'm still trying to figure out on a daily basis what it's trying to tell us. But I do think that this DXY move is really mostly euro. As I mentioned, dollar really hasn't bounced much against the pound. Slightly it has, but nothing really that notable. And I do think in the months to come, as the rest of the world sort of catches up to our inoculation process, is that the dollar will then have to go back to dealing with the reality of a budget deficit, that there's no end in sight in its trajectory relative to GDP. And we just saw the February goods trade deficit that rose to a fresh record high. And those will continue to be secular headwinds for the dollar.
So if I could wrap it up in terms of market action today and where your head is, you're still thinking about inflation expectations being important. You're thinking about interest rates going up and a whole host of reasons for underlying inflation trends to continue to bite, not just over the short term, but over the medium term.
Yes, and I know it's definitely more of a consensus thought. So when everyone hops onto that bandwagon, it makes me want to just reassess and decide whether this trend is still there. I feel like I was on it early last year, but I still look at the fundamentals behind it, and I still think that there's still a trade left here. I still think that energy stocks have more upside. I still think that agriculture stocks have more upside. I still think that precious metals are sort of being left for dead as people have responded to the rise in the slight rise in real rates of the 10-year, but 5-year real rates are near the lows, and this little bounce in the dollar, I call it little because 90 to 93 is not much of a bounce. And yet maybe there's some Bitcoin related sort of transition of funds, but I'm still a believer that both can complement each other rather than one taking over the other. And I still, when looking out over the years to come, I still believe that Asian markets are going to well outperform U.S. markets. And that's a long-term theme, and nothing in the short term changes that belief.
Well, good. Yeah, it's good to get an update on your views given what's going on in the markets. I appreciate you coming back on, and I'll talk to you again soon.
Thanks, Ted. Always fun doing this with you.
So to continue the conversation about these input costs and rising commodity costs, we have Trevor Hall, who is the host of Mining Stocks Daily. That's at miningstockdaily.com. Trevor, welcome to Real Vision.
Hey, it's a pleasure to talk to you once again.
Yes, I've been on your podcast, and so it's great to have you on here, especially on a day like today where we're thinking about people talking about a commodity super cycle. We're talking about input costs rising. You look at mining stocks and you look at the mining sector drilling down. So I want to talk to you about what you're seeing in the mining stocks right now, because before this, you talked to me about things that we wouldn't normally talk about. You talked to me, I believe, about copper, and you also talked about gold and silver. Take your pick. How do you want to start?
Let's pick the most obvious poison. That'd be precious metals. I mean, coming off what we saw out of Dallas, the great inflation debate continues. You did see manufacturing input supplies costs being rising. So we'll start with inflation, and obviously one of the best hedges against inflation historically has always been the yellow metal gold. Continues to be tied. The price of gold continues to be tied with yields. We're seeing a huge spike once again as we're recording in the 10-year, up to above 170, I believe, once again, and gold's getting pushed down close to just above 1700 futures basis. We're curious if we're going to see kind of a bottoming here finally in the gold price after that big move last year from new all-time highs. It's been a long consolidation downward trend, 8 months in the making now. But we'll see where this kind of its relationship with that 10-year and the yields continues to move. If the 10-year still sees a sell-off and rising yields, I would assume to believe gold still has more downward to go. But I really focus on the miners. And if you talk about the gold miners, like there's this continued dialogue of miners into that value trade, rotating out of the growth equities into value equities. Given the price of gold miners don't need $2,000 gold to be profitable. I mean, they're incredibly profitable right now at $1,700 gold. Margins continue to be improved. Anything above this, I mean, if you have an all-in sustaining cost anywhere from $1,000 an ounce to $1,200 an ounce, I mean, there's improved margins. Your biggest input cost to produce is typically energy, so your diesel and your oil. Even though those have been rising for the last couple of weeks, they're still reasonable costs. But back in 6 months ago, when oil was really in turbulent mode, those margins just continue to be improved. And so I would really make an argument in that value trade that there's not many sectors providing as much value based on those production margins as gold miners are right now. On top of that,
it's over for that matter. What's the relationship in terms of gold miners versus silver miners in terms of who's better value given the dynamics of the market that you're seeing right now?
Well, there's not very many pure silver miners out there, and I haven't done as much digging into the margins of pure silver producers. A lot of times, silver is produced on the back end with gold, so metals aren't necessarily when you mine them. Rarely do they just come as one metal itself. There's like gold or silver, gold or copper. There's a combination of them when they're mined, and then they're separated through the process and the metallurgy. So that's a harder one to do. I mean, I think margins for silver miners are still pretty good right now. Obviously, there'd be a lot better, $25 or more. But the sentiment towards silver right now isn't terribly great. I think gold could see another side down, but I think silver probably is inevitable here. Another couple dollars down before another move higher. So,
when we talk about that, I look at gold as almost the pure precious metal. Silver has a relationship to industrial use and into what's going on in terms of the economy. So, going back to that whole inflation thing, and when you talk about copper and tin, well, let's look at copper first. Dr. Copper was spiking earlier, but it sort of trailed off. Do you think that this has legs, this rally in commodities, and what are you seeing in the commodities mining sector?
Copper is a true supply crunch right now. There's a couple of things happening on the back end that, unless you weren't really paying attention, that you might miss. If you're just looking at the price, we're seeing consolidation still around or above that $4 a pound. But this is kind of an important deal because we have a lot more demand for copper as a metal than we have supply coming online. So if we're looking at let's see, so who came out? Trafigura came out and said we're going to need. No, excuse me. It came out and said we're going to need 10 million more tons of copper to meet demand. Now, that's not something you can just press a button and turn on. What we don't have is enough supply coming online via mines to meet that demand. Where we're at now, given feasibility level studies of bigger copper production projects that haven't yet been built, $4 copper seems like needs to be the foundation. Anything below that makes a lot of those projects hard to build, because we're talking billions of dollars to build just one project. And then you have to, that you're talking about almost a decade to get these copper projects built. So the worry is, even if, say, tomorrow you were able to finance the building of some of these projects, you're looking at almost a decade to get them built. And then where are we going to be in this metals commodity cycle 10 years from now? So that strengthens the supply argument for the demand. Behind that, what we're seeing right now is actually an interesting story on the smelter side. Copper miners come out, they produce a concentrate, give or take 60% in the concentrate of copper. The rest is made up of stuff you don't want, not copper. So what we're seeing is they take those to the smelters, and then through that, the real story is the treatment and refining charges to the copper smelters. So treatment charges an important source of revenue for smelters. So they're paid by miners when they sell the copper concentrate. So the semi-processed ore, those concentrates, are then refined into the metal. Those charges typically go down when the concentrate market tightens, and smelters have to accept those lower terms to secure their feedstock. That average cost of treatment charge historically is around $60, $70 per ton. It's trading as low as $10 right now per ton. So right now, smelters are willing to take that low payment because they're betting on a higher price of copper, that copper is going to go up, because it's not necessarily, it doesn't do them to take that low of charge. Like it's not economic for them unless they're betting that price goes up. So that statistic alone shows we have a very, very tight copper market, especially in the concentrate from the miners to the smelters. So more than 2 million tons of annual smelting capacity will be on maintenance in the second quarter as well, with a couple smelters in China. So you're taking that offline. So
when I'm thinking about it from an inflation perspective, who's using this copper? What are the demand characteristics underneath that that would seep into inflation expectations?
Electrification is the most conductive metal in the world. If you want anything electric, anywhere from new energy to infrastructure, copper wiring, technology manufacturing, it all uses copper. So while we're talking about increasing production and getting technology in all many sorts of forms, it's going to take this metal to get it. I mean, we just saw Tesla raise their prices on the cars. And it's the most obvious case of why companies that produce things that use raw materials such as copper are going to have to increase their prices. It just happens to be it. But this comes back to the supply demand crunch. There is a massive supply crunch happening in metal, and it's just completely obvious. There's not enough coming online to meet the demand. And now you're talking $3 trillion in infrastructure spending in the US. I would argue that it's I mean people might not like to hear it, but $3 trillion to get done what we want to get, what supposedly Biden and the administration want to get done, isn't enough, especially if you have rising costs of goods such as copper.
Well, when I spoke to you in preparation for our spot here, you also talked about tin as well in terms of a supply-demand imbalance. What's going on with the tin miners?
Yeah, so tin, when the commodity cycle was basically moving downward and downward and prices were lowering, there's less incentive for exploration, right? So fewer companies were spending money on exploration throughout the world. And it's kind of come to a moment in time where, chickens come home to roost. We have zero supply of tin. Tin, for people who are interested, like, why do I care about tin? Tin is actually the glue used for metal. So it is used to glue, say, circuits and electronics boards, the chips to the boards. It's soldering is an important aspect of manufacturing, to put one metal to the other, which typically wouldn't bond together in the first place. So thanks to this positive growth forecast in electronics and green tech and 5G, robotics, like all this new advanced levels of manufacturing, solder usage remains to be in demand, which means tin continues to be in demand and incredible deficit. The spot price of tin right now, well, since the beginning of the year, has risen 25%. It is in crazy backwardation. In London, I think cash spot price is about $25,000 a ton. 3-month forward futures contracts at $28,000. So and there's not enough supply coming online. There's no tin to meet the demand. Any tin that is mined and manufactured, it's going straight to the that's going straight to the technology manufacturers. So that's evidently we're hearing reports that there's some metal available in Asia, predominantly countries that produce tin: Malaysia, Myanmar, Indonesia, Congo. There's no tin production in the U.S. or North America, for what I know. I think there's some in Brazil, South America, Bolivia, but there's, the grade is important. Types of the tin metal is important. There's just not enough being produced to hit the market, and so we're seeing a massive crunch here. So there is reports that the Defense Logistics Agency is prepared to start selling some of their stock to the market. I think they said they have like 4,000 tons. It's not enough. It's absolutely not enough.
Yeah. So, I mean, if I could wrap what you're saying into a bow, basically, if you look at some of the most important markets that are out there in terms of, the future, we're talking copper, we're talking tin, in particular, and let's leave aside precious metals for a second. We're looking at a supply-demand imbalance, which will keep these markets elevated for some time to come.
Yeah, I would say 10 years. It's a long time. Because you can't just turn on a mine. It doesn't work that way. I mean, you're talking a decade to build, to even get into production and deliver to the market in the first place. You're talking about exploration work that just doesn't happen overnight. That takes years to define what kind of resource you have in the ground and create a mining plan and then finance those projects to get them built. But this is all when exploration work has been completely underfunded for a generation. This is the time where it's going to start paying the price, and unfortunately, markets and the consumers are going to eat through it in the way of inflation and higher prices.
Well, Trevor, I think we're going to have to leave it there for right now. Too short a time, but let's have you back on to talk about the mining space a little bit more. I want to talk about some of the junior miners. I want to talk about oil as an input, what's going on there. I want to talk about nickel, a lot of different things that we can talk about.
It all starts there, doesn't it?
Definitely.
All right,
thanks again.